Worried about slumps in the stock market? I've got 2 words for you. Don't panic. Hi, I'm Shannon Terrell, senior writer for Finder.com's share trading and investing channel. And I'm here to give you some tips for weathering those unpredictable shifts in the stock market. Today, we're going to cover the best strategies for keeping your investments safe when the stock market slides. Let's investigate the 5 things that you need to do when the market is down. You may have heard the term correction used before when experts talk about stocks falling, but what does this mean exactly? A stock pullback of up to 10% is known as a correction. There are many reasons a company's stock may fall, including profit taking, large funds shifting to new sectors, a series of bad earnings reports, or simply bad economic news. Now, every so often, we see a pullback of 20% or more. This is known as a bear market. Bear markets can last anywhere from just a few days to a few years, depending on market conditions. One thing you shouldn't do is panic. I know, easier said than done. But you may be relieved to know that in the long term, the stock market goes up. That said, you do want to be prepared if you expect a downward stretch. Here are 5 things that you should do when the stock market is down. Let's be honest, stock market drops are scary. You may be worried about losing some or all of your investment. Now, some volatility in the market is normal, and in most cases, you shouldn't worry. What you should do is figure out why stocks fell. Getting to the bottom of a correction will help paint a clearer picture of your portfolio's health. If your stock slipped, say, a few percentage points because of a disappointing earnings report, you may want to take a step back and wait for the dust to settle. Stocks are frequently impacted by headlines, and truth be told, they rarely hold on to losses for long. Now, assuming that you have a well-diversified portfolio and that you're not in too much debt, you're probably in a good position to weather some stormy market conditions. Wiping out your portfolio is extremely unlikely. Now, it's okay to check in on how your stocks are performing when the market takes a hit, but resist the urge to sell off all of your shares. Hiding your cash in a mattress is not the answer. Chances are your investments will rebound. So take a deep breath and don't make any hasty decisions about your holdings until the market settles down. This leads us to our next critical piece of advice. Take some time to think and don't sell off your stocks haphazardly. This is the time to examine your holdings and figure out what your strategy should be going forward. During this time of reflection, ask yourself this question: do I believe in the company that I've invested in? If the answer is yes, ride out the storm. Important in this step is a little bit of research. Is the company profitable? Is senior management secure? And does the company have a solid vision for the future? Every company deals with a little bit of volatility from time to time. And if you're investing for retirement or other long-term goals, a correction and even a bear market shouldn't negatively impact your holdings over the long haul. Now that you've reevaluated your investments, it's time to think about what you should sell, if anything. If you absolutely have to sell something, your short-term stocks should be the first to go. Maybe a particular stock has been underperforming for a long time, and the recent correction took it down too far. Or maybe you just want to limit your losses. Penny stocks and other risky investments may not recover for years. And if this is the case, you can sell those risky short-term investments, but try to hold off on selling long-term investments. Things like retirement funds, college savings, and the like should be considered off limits. Bear markets and crashes present unique opportunities. Let's say you've had your eye on a particular stock for a while, but the shares are outside of your budget. A slump could be the perfect opportunity to buy these shares at a deep discount. And given the fact that stocks typically rebound, your investment will likely get a boost over time, even if the stock dips a little lower after your initial investment. Many platforms, including Robinhood, allow you to buy and sell shares through limit orders. This allows you to buy shares at a limit price or lower. Essentially, you're setting the lowest price at which you're willing to buy a particular stock, and the order will not be executed unless the stock trades at your limit price or lower. Now, if all of this talk has you feeling a little overwhelmed and you're not quite ready to weather a market downturn, a market simulator may be able to help, and you won't have to risk any of your own money. Some apps, including Webull, offer a paper trading feature, which allows you to pick securities, make trades, and track the results, all without risking a dime. This is a simulation, so you get a better understanding of market swings and how they could potentially impact your stocks. This is a great way to practice before you invest any of your own money. This way, you'll be more prepared for the next big stock market decline. No investor likes to see their stocks take a hit, but there's typically no reason to panic, and a dip in the stock market can even be a great opportunity to buy shares you might not have otherwise been able to afford. If you'd like more information about what to do when the stock market is down, check out our guide over at finder.com. It's linked in the description box. And if this video was helpful, please hit the like button. And don't forget to subscribe and ring the notification bell so you'll be the first to know when new Finder videos drop. Thanks for watching.